K5.3 is estimating the inventory. We have 2 learning objectives. You need to be able to estimate the cost of merchandise inventory, and you need to be able to calculate the inventory turnover ratio and days sales in inventory. Okay, so gross profit method of estimating inventory. Estimating inventory by using the previous year's percentage of gross profit on operations is known as the gross profit method of estimating inventory. So here they're showing us the estimated merchandise inventory sheet using the gross profit method. It tells us what department we're in, discount grocery here, and the date. And so here we're giving our beginning inventory, net purchases, then merchandise available for sale by adding those two together, net sales to date, less estimated gross profit. Notice here it shows us what they're doing. It's taking net sales times the estimated gross profit percentage of 48%. And then we have our estimated cost of merchandise sold, and then our estimated ending inventory. Okay, the retail method of estimating inventory is estimating inventory by using a percentage based on both the cost and the retail prices. So again, they're showing us the same type of sheet, an estimated merchandise inventory sheet. However, this time it's retail method. Here they're showing us what company it's for, the date. Here they're showing us 2 different columns. We have our cost column and we have our retail column. So beginning merchandise inventory at cost and at retail. Then we have our merchandise purchased at cost and at retail. Then we have our merchandise available for sale, cost and retail, and then the sales to date. Here we have our estimated ending inventory at retail, and then our estimated ending inventory at cost. Here, notice again, they show us in parentheses, we're taking the inventory at retail times the percentage of 58.6. Okay, so inventory turnover ratio is the number of times the average amount of merchandise inventory is sold during a specific period of time. So what we're going to do is we're going to take cost of merchandise sold divided by the average merchandise inventory to get our inventory turnover ratio. Okay, so if we have a low inventory turnover ratio, that's going to indicate a low return on investment. Next thing that we see is a day's sales in inventory. The time that is needed to sell an average amount of merchandise inventory is called days sales in inventory. So we take the days of the year divided by that inventory turnover ratio, and that would give us our days sales in inventory. Number 1, on what assumptions is the gross profit method of estimating inventory based? That a continuing relationship exists between gross profit and net sales. Number 2, to use the retail method of estimating inventory, what records must be kept? We need to have separate records of both costs and retail prices for net purchases, net sales, and the beginning merchandise inventory. Number 3, explain an inventory turnover ratio of 5.0. So what that's telling us, an inventory ratio of 5.0 means that our business sold its average merchandise inventory 5 times during that current year. And number 4, explain a day's sales and inventory of 60. What that's telling us then is on average, each item in merchandise inventory is sold 60 days after it is purchased. That is the end of 5.3 lecture. You can now go on to the 5.3 work together.